Welcome to DWS Market Update. The first 6 weeks of this year have produced headlines enough to fill an entire year. The abduction of the Venezuelan president by the US president's desire to make Greenland US territory, escalation in Iran, and the US federal prosecutor's investigation into the chairman of the Federal Reserve, Jerome Powell. All this was accompanied by historical rapid price increases for gold and silver, which shortly afterwards suffered historically rapid price declines. These are difficult times to keep a cool head, but it is even more important to do so. So what should investors do? First, note that Donald Trump listens to capital markets. After share prices reacted sharply to the unclear claims on Greenland, and moreover, many managers in Davos made it clear that Europe is a very attractive sales market for them, which they could lose if there is a rift between Europe and the US, the president relented. No territorial claims, no punitive tariffs or anything similar. The nomination of Kevin Warsh as the future Fed chairman was also a normal choice, one who can even count on the support of some Democrats. An overly unorthodox choice would have driven up US yields and thus the interest burden on the already fragile US budget. Second, if you take a step back, you realize that the economy is coping well with all this. If the crises of recent years have taught us anything, it is that people, and therefore companies and economies, are very adaptable. They adjust to new circumstances. US tariffs have driven up inflation slightly, but overall, companies are coping well with the new tax. The US economy grew very strongly in the third and fourth quarter and is likely to continue to grow at a high pace, driven by investments in data centers, power plants, tax cuts, and defense spending. Global trade grew by around 4.5% in real terms last year. Europe is experiencing an upswing fueled by investments in infrastructure and defense and supported by an increasingly robust private consumption. What does all this mean for investors? Against this backdrop, a globally diversified portfolio is still a very good position. Bond yields are at a comfortable level. With stable economic developments expected, the outlook for equities remains good in the US and in Europe. So there is no reason to bury your head in the sand. With that, I say goodbye until next time.